Hello, everyone. Thank you for joining us on the DST Essentials with K Properties and Investments, an in-depth look at all things Delaware Statutory Trust and 1031 exchanges. My name is Eugene Ma, Vice President with K Properties and Investments. We'll begin with risks and disclosures. This material is not tax or legal advice. Please speak with your CPA and attorney for tax and legal advice. All offerings discussed, if any, are Regulation D, Rule 506C offerings, which are only available to accredited investors, generally described as having a net worth of over $1 million, exclusive of primary residence. Please verify with your CPA and attorney if you qualify as an accredited investor. This information is educational only and is not an offer to purchase securities or DST properties. Such offers are only made through a private placement memorandum, which investors are encouraged to read. Past performance does not guarantee future returns. Diversification does not guarantee profits or protection against losses. Returns are never guaranteed and could be lower than anticipated. All real estate and DST properties may go down in value. Securities are offered through Finex, member FINRA, SIPC. Finex and K Properties are separate entities. Thank you, everyone, for listening in. And now I'd like to turn the call over to our guest of honor, Dwight K., founder and CEO of K Properties and Investments. Go ahead, Dwight.
All right. Thanks so much, Eugene, and thanks, everybody, for joining us today. We truly appreciate each and every one of you for taking the time out of your busy days and jumping into our educational call on 1031 exchanges, Delaware Statutory Trust, and today, the presentations on 721 exchanges, the 721 exchange, how that could potentially work for you as a 1031 exchange investor as an exit strategy. Okay, so we really appreciate everybody for joining us. Quick background for those of you that are new to K Properties. I founded K Properties to basically be a specialist in 1031 exchange, Delaware Statutory Trust investments for our investors. And I've been personally working with Delaware Statutory Trust and 1031 exchanges and 721 exchanges for nearly 2 decades now. And, fast forward, the K Properties team members have helped over 2,270 clients nationwide purchase over 9,100 DST investments as well as 721 exchange investments. So we're truly specialists in this industry. Doing this for a very, very long time. I've personally been invested in over 90 different DST offerings for my family. And, at the end of the day, that experience, we're passing it along to our investors because I've personally invested with many of these Delaware Statutory Trust sponsor companies throughout the country. We've seen them do a good job, for our investors. We've seen them do a not so good job at times. And we've really honed our investment strategy based on that experience, right? We really liken it to if you're getting a knee surgery, you want to use an orthopedic surgeon that might have done 10,000 knee surgeries instead of your general practice doctor that maybe did, 2 or 3. And that's really what the difference is with K Properties is our vast experience with these DSTs, 1031s, and 721 exchanges. The KPI 1031 Marketplace platform, it provides access to nearly 25 different DST sponsor companies that are putting together these DSTs and offering them to 1031 exchange investors. Many of them have the 721 exchange as an exit strategy, which we're going to jump into here. So when you log in at kpi1031.com, you'll be able to view from all those different sponsors. It's about 20 to 40 different DST offerings, give or take, at any given time, that you'll be able to view and you'll be able to compare, contrast them. And then from there, K Properties, we're not a sponsor company, okay? K Properties is not a sponsor company. We're advisors, advising our investors based on your specific situation, goals, objectives, risk tolerance. These are the 5 out of the 40 offerings on the platform that we believe make the most sense for you. And here's why. And we'll walk you through the potential pros and cons of each one of those offerings. So that's really what set us apart, is providing that advice, that guidance, and then the vast amount of experience seeing these properties and these sponsors operate over the many years that we've been doing this. So that's a little bit about us. Now, the 721 exchange exit strategy. So essentially, what is a 721 exchange? Section 721 of the Internal Revenue Code states that no gain or loss will be recognized when property is contributed to a partnership in exchange for an interest in the partnership. Okay, and there's essentially it's a tax-deferred exchange, just like a 1031 exchange, but you're not outright selling your property. You might have a 50-unit apartment building that a large REIT wants to buy. And instead of selling it outright to them, you decide, I'll take shares in their operating partnership in exchange for my property. And that's a tax-deferred basis, okay? And now you're diversified in that REIT portfolio, not just in your 50-unit apartment building. And so that's the typical way the 721 exchange works. And quick case study, we had a client back in 2020. They had, invested with me in DSTs through a 1031 exchange. They sold a property, a hotel, back in, I think it was 2013. And, did a 1031 exchange. It was a couple $1 million. They were really satisfied. And they told me, they said, hey, we also have this portfolio of hotels, about 18 to 20 different hotels that we own throughout the Midwest. And we will be selling them one day, but we wanted to, do this small piece as a test investment just to see how you work, how your company works, and how these DSTs work. Fast forward 2013 to, it was fall of 2019. They contacted us, this family, and said, we're under contract. We're selling to is essentially one of the largest buyers of real estate in the world. Okay, a household name. Everybody on the call would know their name. They're in the news all the time. We're selling to them. We're going to have, it was roughly about $130 million of equity that they were going to have. And they decided that they wanted to take half of it and do a 721 exchange, right? With that sale, half of the equity would go into that large institutional real estate companies, their REIT. They had a large non-traded REIT. They put half of it with them through a 721 exchange. The other half, okay, of their equity, which is about $65 million, they wanted to build a highly diversified portfolio of DSTs with K Properties. So that was a unique situation because the client had a portfolio that a large institution wanted to offer them the ability to do the 721 exchange. So they did half with them, the other half, and they bought into 20 or 30 different DSTs and build a diversified portfolio with K Properties. So that was really unique. And the thing is that a lot of times with the 721 exchange, it's been around forever. Not many people know about it. I was actually, I wrote an article. It was before the financial crisis. I think it was 2008 on the Section 721 exchange. It's kind of like the lesser known cousin of the 1031 exchange. It was published in a real estate journal on the East Coast. And so, I've known about it and worked with it for many years, but most people don't know because why? Because most large REITs and institutional buyers, they don't want to buy a single-family home or a 5 or 10 unit apartment building or, a 10-acre plot of land or, the typical, investor is not going to be offered that ability to contribute their property and do a 721 exchange into a large portfolio of real estate. Okay, so, a large REIT, they want to buy a 300-unit apartment building, not a triplex, in Dana Point or in Brooklyn or, South Florida, right? They don't want to buy, $2 million self-storage facility in Ohio. They want to buy a 1,000-unit self-storage facility. And so it just doesn't, you don't get that as a typical retail or mom-and-pop investor. You don't get offered that ability to contribute your property via the 721 into these large portfolios. And that's where the Delaware Statutory Trust kind of steps in and solves for that equation, okay? And it's basically a two-step process, okay? So you own a property. It might be a single-family rental, might be a small warehouse, an office building, medical office building. I mean, at K Properties, we've had thousands of investors nationwide selling every type of asset you can think of. Small plots of land, medical buildings, storage facilities, industrial properties, hotels, really every asset class you can think of. We've helped clients with their 1031 exchange into DSTs. So whatever it is you're selling, a 2-unit, a 200-unit, anything that you're selling, if you've got, $18,000 of equity or you've got $100 million of equity, you sell your property, your funds go to your 1031 exchange accommodators account, okay? From there, you're working with K Properties, you're working with our team, we're helping you understand how the DSTs work, how the sponsors work, and then from there, digging into each of the properties, walking you through, again, what are the pros, what are the cons, and then helping you build a diversified portfolio. And when we say diversified, it's, we believe it's the prudent thing to do. But it's important to note diversification doesn't guarantee profits or protection against losses. It's just the way that we think it makes sense to invest, and that's backed up, by many, many professional investors. So, we build that diversified portfolio, and you exchange your, $25,000, you sold a lot that, we've had many clients that have bought small, pieces of land and then sold them 15, 20 years later at a nice gain. Or it could be, you're selling a big apartment building and you've got $50 million, whatever it is, right? Our typical client is investing anywhere from, $400,000 to $5 million bucks. But again, we have smaller, we have larger. So you sell your property, your funds go to your qualified intermediary. We help you understand the DSTs, help you understand which sponsors make the most sense for you. Should you be in a leveraged DST? Should you be in a debt-free DST? What asset classes? Multifamily, self-storage, medical, distribution, industrial, all the different asset classes. So then you exchange into your DSTs, okay? So the property's exchanged, for an interest in a Delaware Statutory Trust. And then from there, that DST, right, you'll be able to walk through this with the K Properties team. Certain DSTs have as a potential exit strategy the 721 exchange, because the sponsor of that DST may have a portfolio of, $500 million or $1 billion or $5 billion of assets that they are going to combine and, build that diversified portfolio for investors. And so certain sponsors will have a 721 exchange exit strategy, others may not. But you get to decide, yes, I like this portfolio that this sponsor has. I like how it looks. I like the assets. I like, the leverage ratio. It makes sense for me. And then that's the DST that you would go into. And typically about a couple years later, 2 or 3 years after you exchange in the DST, then the sponsor, okay, offers you the ability to do a 721 exchange and exchange your DST interest for operating partnership units in the 721 exchange vehicle, okay? We call those OP units. So you 1031 out of your 2 units, right? You might have $1 million. You 1031 in the DSTs. The DST then, after 2 years, goes into the operating partnership, okay, on a tax-deferred 721 basis. So you contribute. You might have bought into a FedEx distribution facility, right? And you had, call it $300,000 into a FedEx distribution warehouse facility, long-term net lease to FedEx. From there, that DST, you're offered the ability to put your $300,000 into that large portfolio. Might be 500 or 600 million of, FedExes, Amazons, Walgreens, CVS's, all different tenants, a broad diversified base of tenants. It might have some multifamily properties in there. It might have some medical properties in there. A broad diversified portfolio. And now your $300,000 in that one FedEx deal is in the broad portfolio on a tax-deferred basis, and that's the 721 exchange. So, again, you can't sell your 2-unit to the 721 vehicle. I mean, you could, but most 721 vehicles want to own, larger, higher quality properties than just a small, single-family rental or a 10-unit apartment building in Beverly Hills or whatever it is that the client's selling, okay? And so that's how you're able to go from the 1031 from your property into the DST, and then from there into the larger 721 vehicle on a tax-deferred basis. So, again, the structure allows holders of a DST interest to exchange their DST interest for an economic interest in the 721 vehicle in the form of operating partnership units. And that's by contributing that property to the partnership in a 721 exchange transaction. So why do investors utilize the 721 exchange strategy? There's a handful of reasons, and we're going to walk through. But the first one is tax advantages. Excuse me. So when real estate is typically sold, the investor pays taxes on the capital gains realized, as well as your depreciation recapture tax, as well as your Medicare surtax. And it's not just federal capital gains, right? It's state capital gains as well. So this leaves the investor with less capital for reinvestment. So with the 721 exchange, similar to the 1031 exchange, the investor can avoid this hefty tax through a tax-deferred exchange of real estate or interest in the DST for shares in an operating partnership. Okay, so it's highly tax advantaged. You're fully deferring your federal, your state capital gains taxes, your Medicare sales tax or surtax. It's similar to a 1031 exchange. Okay, so it's a tax-efficient way to dispose of real estate, like a 1031, but with the 721, you're moving into a much larger, typically, portfolio of real estate. And so capital gains, those taxes that you deferred, they can be deferred until the investor sells the OP units, converts the OP units to REIT shares, or the contributed property is sold by the acquiring operating partnership. Okay, so you're going to continue to defer those taxes as you're in this 721 exchange. So, second reason, why do investors utilize the 721 exchange? It's diversification. Many investors, they do incur concentration risk by owning one property in a single market. Okay, so similar to, you might have had a 38-unit apartment building in LA or Florida or Texas or New York, wherever, whatever you're selling. You've got a lot of times our clients will have a net worth of typically $2 to $20 million. That's kind of the typical client. We've got, clients, much higher than that, but our typical client, $2 to $20 million bucks, investing $300,000 to, $5-6 million with us. And so, that client, a lot of times will have one asset or a small handful of assets that are the majority of their net worth. The bulk of their net worth is in a single asset. And so they realize, wow, I've got this, 38 units, and if, the city passes this rent control that they're talking about, or, something happens in the market that my property's in, or, whatever the case may be, they realize they're highly concentrated in one particular asset. That's why they're wanting to do a 1031 exchange into DSTs in the first place, to become diversified, right? They don't want to have, $5 million of their $8 million net worth in one building in one city with maybe one tenant or just a handful of tenants. They want to have it diversified over, 5, 6, 7 different DST offerings with, 2,000 apartment units and, tenants such as Amazon, FedEx, Walgreens, CVS, large Fortune 500 companies, some of the largest companies in the world. They want to be diversified there. And again, it doesn't guarantee profits or guarantee protection against losses, but it's the prudent thing to do. Also, a lot of the clients, they want hands-off management. They don't want to have to deal with the tenants, the toilets, and the trash. They're tired of managing it. So not only do they have concentration risk, and with the rent control laws that are being passed and various things that are happening in certain cities, it's really putting pressure on landlords, owners of real estate. They've had a lot of appreciation, but now they're seeing they've got a lot of risk. So they want to sell, they want to diversify, and they don't want to have to manage again. So they do the 1031 into DSTs, and then from there, the 721s, it's even a greater form of diversification potential. So 721 vehicles, they tend to own many assets diversified through different markets. Okay, so it's potentially reducing concentration risk, because instead of going from one, say you invested in that $300,000 FedEx, instead of just being right there, you're now in a portfolio that might own 25 FedExes, okay, and multiple other different tenants and asset classes. So it's reducing that concentration risk. So, for example, instead of owning that $500,000 or $300,000 DST interest in that one FedEx leased industrial building, the investor is able to 721 exchange on a tax-deferred basis into a diversified portfolio that may contain over 2 million square feet of industrial, multifamily, retail, medical, and mixed-use properties. So, and various users in this hypothetical example would be FedEx, Amazon, Frito-Lay, PepsiCo, Walgreens, CVS, Fresenius, DaVita, Dollar General. Again, some of the largest companies in the world in this broad-based diversified portfolio. So diversification, again, is a big reason why investors like the 721 exchange. Next, why do investors utilize this 721 exchange? Income potential. So investors potentially are going to receive income generated through distributions to the holders of the OP units. Okay, so you're going to be receiving that distribution either on a monthly or quarterly basis, depending on the 721 vehicle, however they have set up their distributions. But it's typically monthly distribution to investors via ACH direct deposit. Okay, so, and the 721 vehicle, it's going to have the goal of increasing the income potential to investors over time through acquisitions and portfolio optimization. And then on top of that, investors enjoy that income potential and it's tax advantage via depreciation and other write-offs to help shelter those distributions. So income potential is a big part of why people like the 721 exchange. And then also appreciation potential. So investors that are in the 721 exchange vehicle, they're able to participate in that potential appreciation that's realized at the individual asset level as well as at the enterprise value level. Okay, so these 721 vehicles, as they get bigger and bigger and bigger, they may become candidates to be acquired by larger portfolios. And at times, not always, there can be value placed on that enterprise value where an institution may come in and able to invest, $1 billion for one portfolio that, might have 200, 300, 400 properties in it that have been aggregated over time. So there's a potential for appreciation there. The 721 vehicle will also be positioned to potentially take advantage of market opportunities via new acquisitions that are designed to potentially enhance shareholder value. So essentially, you as an investor, you might have 721 exchanged in, but that vehicle, that 721 REIT, will likely continue to buy properties as time goes on. And that's kind of similar to, not the same, but to like dollar cost averaging in stocks, continuing to purchase in the market as the market goes. Even though you personally don't have a 1031, don't have a 721, you get to take part of that. Also, 721 vehicles are typically positioned to optimize the portfolio through select asset sales and subsequent 1031 exchanges into new opportunities with greater appreciation potential. So again, that's that portfolio optimization that the 721 vehicle sponsor is going to be utilizing in an effort to enhance, distribution potential to investors as well as appreciation potential. And, it's really important to note, and we talked about it earlier, Eugene mentioned it, in all real estate, whether you own your own real estate that in whatever city and town you're in, whether you do the DSTs or whether you do a 721 exchange vehicle, the underlying asset are the properties. And with property, there's no guarantees. Okay, there's no guarantees for income. There's no guarantees for appreciation, and you could lose your investment when you invest into property. So it's really important to understand the risk factors, read the private placement memorandums prior to considering a DST or a 721 exchange, and just know that this is the same as the properties you own. Okay, there's no guarantees. Next, another reason why investors utilize the 721 exchange is liquidity potential. So the 721 vehicle may provide investors with the option of liquidity on a partial or full basis. So investors will have the option to liquidate a portion of their shares in combination with their tax planning strategies. So it's a feature that many investors may never need or desire. However, knowing that it is available provides peace of mind and options for investors. So liquidity is a potential for 721 exchange programs. Most of the vehicles out there that we work with at K Properties have that liquidity potential, but they do have certain circumstances where they are able to limit or gate the liquidity, okay? And that's all described in the private placement memorandum. Typically, it's 5% of the outstanding share value per quarter can be liquidated, and that's so that if there is a catastrophe in the world, banks failing, economies collapsing, war, whatever it is, so that the 721 vehicle sponsor doesn't have to fire sale all the assets at the wrong time, because all the investors go, I want my money back. And so we think it's actually a prudent thing to have that in there, but it does provide liquidity where when you're in a DST, it's an illiquid investment. There's typically no liquidity feature. So that being said, the liquidity potential that the 721 provides, a lot of investors do enjoy it. Now, it's important to note, that some of these large, REITs out there that have the 721 program, they have utilized that liquidity gating feature. And that's because a lot of their investors are cash investors that may not have a gain. They just got income, and then after a couple of years, they get spooked in the markets, and they want to get out, right? And so they start gating it, where programs that are heavily 1031 into DSTs and the DSTs of 721s, those investors, they could utilize the liquidity feature when they went into the 721 to get liquid, and as long as it's within the typical 5% redemption allowance per quarter. However, they're going to be hit with depreciation recapture, capital gains, federal, state, Medicare surtax, just as if they had never done a 1031 exchange. So our thesis is that those 721 vehicles that are heavily 1031 investors into a DST, which then went into a 721, the demand and the request for liquidity, we believe it'll be much lower, because those investors, if they were to tax out, they're going to be hit with those taxes, and they might lose 30, 40, 50% of their invested equity, as opposed to these large, institutional REITs that are out there, where most of their investors are in qualified plans, so it's after-tax dollars, or they're cash investors that may not have a gain. And so we believe that you're going to see a much lower redemption request amount in a 721 vehicle that has mainly 1031 exchange investors with a lot of built-in gain. And so that's kind of a nice thing for investors, as we have seen some of these larger 721 REITs out there shut down their liquidity features when there's been market turmoil and too many investors requested their funds at once. So, and that's something that the K team, as we're walking through the 721 offerings that we have available, that's something that we'll walk you through and kind of help you understand what it looks like. And that's something that you just don't get with somebody that does these, once or twice a year or once a month. We're doing dozens and dozens, every week. We've done thousands. We have clients all over the country. That's our expertise. This is our specialty. So the next thing is estate planning. So upon death, OP units of your 721 exchange can be equally split and either held or liquidated by the beneficiaries of the trust. Okay, so that's a really nice thing for investors that they might have 4 or 5 kids and they're thinking about estate planning, and if they just keep their property or their portfolio of properties, well, guess what? Now the kids are all bickering about, well, Dad loved the building and Mom loved this one, or let's sell it. No, I don't want to sell it. Dad didn't want to sell it. So they're freely divisible for the estates to just, the kids can go any which way they want, and it's, they're equally split and either held or liquidated by those beneficiaries of the trust or the heir. Okay, so estate planning is something that investors really enjoy with the 721 exchange, and also the same with the DSTs, which is nice there too. So the beneficiaries in these 721 exchange vehicles, the same for the DSTs, receive a full step up in basis and can avoid capital gain taxes and depreciation recapture tax. So this allows investors to plan for the future with the opportunity to transfer wealth to their heirs in a highly tax-efficient manner, and allowing them for individual flexibility when liquidating. Again, liquidity is never guaranteed. You have to read each offering's private placement memorandum to go that, will walk you through their liquidity program and what the features are of it and the limitations of it. So you have to understand that, and we'll help you understand that. But it is a reason why people like these 721 exchange vehicles, so estate planning. So that's basically it for today. If you visit www.kpi1031.com, you'll be able to log in for free access. You'll get that free access to our marketplace of both 721 exchange UPREIT opportunities okay, as well as traditional Delaware statutory trust offerings. So you'll be able to log in, you'll be able to look at them, and then talk to our team. We value our investors. We truly do. And so we want to talk to you. We want to find out, what your goals and your situation is, what might make sense for you, and then, walk you through why other clients have done the same thing or maybe not done the same thing. And so, when you log in, you'll get that free listing menu of debt-free as well as leveraged DSTs. So at K Properties, we're really focused on minimizing and mitigating risk whenever possible, and that's why we're big proponents of diversification. We're big proponents of not taking on too much leverage, okay? That's one of the things that if you look at DSTs or 721 vehicles, a lot of them do have leverage. And when you're coming out of a property that you may have already paid off your loan and you're at or near retirement, taking on a new loan in a DST might not be make the most sense for your situation, because if that loan doesn't work out, the property could be foreclosed on. You could lose all your investment in that DST. Same for 721s. There's a number of 721 vehicles out there that have leverage between 35 and 70% loan to values, okay? If the market takes another correction, right? We saw the real estate market cool off as interest rates went up, 200-300 basis points over the last couple of years here. The market really cooled and values dropped, especially in certain asset classes. The leverage didn't. The leverage stayed the same, right? So if the market drops by 10% and you're in a 50% loan to value deal, well, you just lost 20% of your equity value, right? And the same as if there's appreciation, 50% loan to value deal, the market goes up 10%, well, you just gained 20% on your equity, right? But when the DST or the 721 vehicle is leveraged, it's a whole nother layer of risk that a lot of people gloss over. They really don't walk clients through it. At the K team, we will truly discuss how this leverage works, what are the potential pros, because there are some, and what are the potential cons, which they're very real cons. And so when you're looking at a 721 vehicle, if you're more of a type of investor that doesn't want to take on additional risk, you would want to consider 721 vehicles that are debt-free, not ones that have that, 40 to 70, 75% loan to value, which a lot of them do. Okay. So that's something, again, that the K Properties team will walk you through the intricate details on. So again, register today. You'll get your free access to the KPI1031.com marketplace, 721 exchange, and DST offerings. We'll also give you a free book on DSTs that I wrote. It was the first book written on Delaware statutory trust investments. Back, I can't remember when, I think it was 2012 or 2013 that I had that published, and it talks about the 721 exchange as well. You'll get a free issue of the DST digest, which goes into, case studies, articles, all the different things about DSTs, 1031, 721, so we'll get you on that. But yeah, we really appreciate you guys. And then also, we do client dinners throughout the country, essentially walking our investors through all these educational concepts, the potential benefits, the potential risks. We really value our clients. So, we have team members throughout the country. We do client educational dinners throughout the country. We just wrapped up a few in Texas. We've got some in Florida coming up. We've got New York, DC, Raleigh, and then all through California and, various other areas. But we'd love for you to come join us at one of those. To get a really good flavor for how we operate, how we work with our clients. You get to meet other clients that have invested with us for many, many years. So we'd love for you to come to that. Also, our headquarters is in Los Angeles. We're just a little bit south of LAX, and we'd love for you to come visit us and see our entire staff, our team, everybody involved in what makes K Properties who we are, right? So we'd love to have you come out. We also have a sister company that I founded with the president of K Properties. It's called Cove Capital, specializes in debt-free DST investments. We founded the company a number of years ago because the DST space just didn't provide the level of debt-free DSTs that we needed for our clients, right? Because we were, our volume, with clients coming to us looking for that specialized expertise in DSTs and 1031s was at a point where we needed more debt-free properties, and the DST sponsors we worked with weren't providing them. So we started our own company. We've got about 2.1 million square feet. We're one of the top, I think it's 10 DST sponsors in the country now. And, you'll get to meet that team, the Cove Capital team, and, the CFO, our general counsel, our lead counsel, all our accounting team, investor relations. So we'd love to have you out, have you meet them. And a side note on that, at K Properties, we're going to advise you on what makes the most sense for your situation. And that's why we have all the other DST sponsors that we work with on the KPI1031.com marketplace, not just Cove Capital, right? Our sister company. It's a sister company, but there is a wall, and you're going to be working with the K team to analyze all the different properties in the market and what makes most sense for you. If the Cove properties don't make sense, that's totally fine. We have clients that invest in other DST sponsors and not choose Cove, but you'll get to see it all. So love to have you come out to our offices, or we'll come to you. Our team's on the plane all the time. We'll fly out to your area. We'll talk with you, your family, your kids, your attorney, your CPA, anybody involved in your decision-making process. We want to help you with that, as much as possible. So we'll come out to you. But with that, our entire team is here to assist you in any way possible, where your K Properties is your dedicated 1031 exchange, Delaware Statutory Trust, and 721 exchange resource. So thanks so much, everybody. Have a wonderful rest of your day. We really appreciate you joining us, and have a great weekend. Thank you.